Hello, everybody. I am so excited to be here on my very first Instagram Live. It's a great day to start. It's tax day, so I'm sure many people who are listening now or maybe later have some questions about how to handle their money, how to handle their finances. Maybe they're scrambling a little bit because they had to write a check, or maybe you're celebrating because you got a refund. So let's get started. One of the questions that I've been getting a lot as I'm out there talking to people, I've gotten a few questions through my website, is how do people know if they're saving enough money? Saving enough money is a really difficult thing to say because it kind of depends on what you're saving for and how big that goal is. When we think about saving for retirement, standard advice is typically trying to save 10 to 15% of your income. But for most people, that's a huge ask. And so, what I say enough is, especially if you're just starting out, is enough to get your company match. So you want to think about getting your company match. You want to think about making sure that you are saving towards your emergency savings fund. And then you can take small steps to get to that 10 to 15% savings rate over time. And that's the most important thing to think about. Let's see if we have got any questions coming in. I'll give that a minute or two, and I will share something else that I've been getting a lot from people, which I have to say is making me feel really very excited, which is that people are feeling like they have found a supportive community when they are joining me online. And I think that's just the best thing ever, because saving money, it can make you feel anxious, it can make you feel ashamed, but it doesn't have to. And so the trick is to take a deep breath, tell yourself that it's going to get better, and then just take small incremental steps to do that. Just got a question. Can an accountant help determine what to save for retirement, or does a financial planner need to do that? Okay, that is a great question, and I'm just going to chunk it up a little bit and say, what are some of the differences between an accountant and a financial advisor? An accountant is someone who is a certified public accountant. They have to take a whole series of tests to become a chartered accountant. It's a very long, difficult process, and what that means is that they are expert at helping you figure out how you can maximize the amount of money that you can take home and keep. And most accountants are great at figuring out ways you can take deductions, ways you can never dishonestly, but basically minimize what you owe the federal government or your state government. Many times, especially if you are a gig worker, you have a side hustle. Even if you're just a regular employee with a W-2 paycheck, you might be entitled to more deductions and more ways of saving income than you might realize. And so an accountant can actually help save you a lot of money. That's especially true the more complicated your financial life gets. An accountant can help you understand how what you're saving and where that money is being saved in an IRA, a 401k, a Roth IRA, or a Roth 401k. They can help you understand the tax implications for that, but they're not necessarily the best expert to help you figure out how much you need to save for your specific financial goals. For that, a financial planner is typically the expert that you should be relying on. And I will say, for most people that are starting out, if you're in your 20s and even in your 30s, your goal should be to save between 10 and 15% of your pre-retirement income. If you're doing that and you're getting a company match, I'm going to tell you right now, you're doing just fine and you shouldn't sweat it. Over time, especially if you've started late, maybe you didn't start saving until your 30s, you might need to think about getting your savings rate up to closer to 15 to 20%. Now, one of the ways a financial planner can really help you get to those numbers is to work with you to understand where your money is going so that you can build up a plan for today, spending a little less so you can direct that towards your savings, and then over time building in sort of a clear path for you to follow so that as you earn more income, you'll be sure to stay on top of your savings goals. Let me see if we've got any other questions coming in. One of the things that I got asked recently at an event was asking questions about where you should be saving. And again, I think it's important to separate saving for retirement, which should be in a tax advantage saving account. And what does that mean? It means that you're either tax exempt or tax deferred on money that you save. And actually, I just got a great question pop in just now. What's a Roth 401k? Now, 401k is a pension plan that is, you get that through your employer. There's a regular 401k, which is just 401k, but there's also a Roth 401k. Now, a Roth is a relatively new addition to the 401k universe. And what a Roth does is you pay taxes up front on the money that you earn. And then after you pay taxes on it, you put that money into a Roth 401k. It grows tax-free. And then when you take it out, you don't own a dime. You don't owe the government a dime. You get all that money tax-free. So that is a terrific thing you can do, especially if you're young and in a low tax bracket now. Chances are, as you get older and make more money, your tax bracket is going to be higher. Chances are, when you're starting out, you're not paying a lot in income tax anyway, so using a regular 401k doesn't give you that much of an advantage, but if you use a Roth 401k, it'll really pay off down the road. You got another question about a tax refund and whether you can save that directly into your 401k account. I wish it was that easy. You can save that directly into an IRA or other investment account, but you can only most employers only let you put money into your 401k that's deducted from your paycheck. So you have to do a little bit of a hack. It's a little bit complicated. You need to go into your company's website and you need to increase the percentage of salary that they're going to withhold. So let's say you're getting, make the numbers easy, $2,000 every 2 weeks from your employer. That's how much you're getting from them. If you got a $2,000 refund, what you do is for 1 week and 1 week only, you want to bump up your withholding rate to 100%. So they take all that money and put it into your 401k plan. And then you want to drop that right back to your old rate. That way they'll take that one paycheck and then you take your tax refund and use that to replace that income that you didn't get into your checking account that instead went straight into your IRA, your 401k. I wish it were easier. I wish there were a better hack, and I'm sorry to say there isn't. So if you want to try to save that tax refund into your 401k, which I think is a great thing to do with it, you've got to do a little bit of a workaround. Which brings up a great question, right? If for those of you who have either gotten a refund or thinking about getting a refund, the best thing you can do with that big pot of money is save it. And if you don't want to save all of it, save a lot of it. You can put it into your savings account. If you are still working to build up your emergency savings plan, you can take your refund and direct it towards your emergency savings. You can take your refund and do that little hack I just talked about and use it to boost up your 401k by temporarily raising your contribution rate and having more of your paycheck go into your 401k, and then take the money from your refund and use that instead of your salary. Another thing you can do with that money is pay down debt. Paying off debt is kind of like saving. It's kind of like the opposite of saving, but it's this two sides of the same coin, right? When you're saving money, you are putting it away for the future. When you pay down debt, you are reducing your future obligations, right? You're reducing your future loan payments. And so if you've got credit card debt, that is an excellent thing to use a tax refund for. Another question, what saving strategy then is the best to use when I can't save all of the refund though? I was hoping to use it for debt. I think that's number one. In my book, Your Best Financial Life, I talk about using saving half of every raise and saving half of every bonus or tax refund. I think, especially if you've gotten a little bit more than you think you might, it's a great thing to do to boost those emergency savings, boost that 401k with that hack, or use it to make a big, big, big dent in your highest interest rate debt. Again, the debt that you have the highest interest rate on, maybe it's a credit card, Maybe you goofed on your buy now, pay later repayments and that thing is charging you interest. That's a great way to use a tax refund. So again, think about paying down debt is another form of savings because it's going to put more money in your pocket longer term. Let's see what other questions we get. I'm going to give this just a second. Okay, I think the interest went down a bit. What's the best way to leverage that? So interest rates are going to go up and they are going to go down. Sometimes you get a great introductory rate on a, let's say, an online savings account. They may offer, maybe still as high as 5%, although that's probably a little high. And then maybe that rate goes down. You can shop around for a higher interest rate. Something else you might just kind of have to do is make peace with the fact that that interest rate is going to move around a little bit. Interest rates have been quite high lately, relatively speaking, and I think it's probable that the next move in interest rates is going to be down, not up. So I think longer term, we cannot expect to see the kinds of interest rates we've seen in savings accounts to be quite as high as they have been. The good news is that if interest rates start dropping, you're also going to see interest rates dropping on any loans that you might have, and mortgage rates will start dropping too. So there's a little bit of good news in that lower interest rate. But it is a fact of life that you are what we call a taker of interest rates. You can't decide how much you want to get. You just have to take what institutions are offering. So if the rate has dropped for you, look around. Maybe there's a better deal. I'm not really sure how much time it's worth spending to keep surfing. I think one of the risks of touching your money, of jumping in there to see if you can get a better rate, is that it can get a little tempting maybe to pull a little out as you're moving it around. So you want to be careful that kind of surfing around for that best interest rate doesn't open up the door to temptation and maybe taking some of that out instead of putting more back in. So you might have to shop around, but it may also just be a challenge to find that high rate. That doesn't mean you shouldn't still do it. You should still absolutely do it. And if the rates drop, that doesn't mean you shouldn't keep that emergency savings in cash. You're just going to have to keep doing that. Are there specific accounts you recommend, or even banks? I have to say I really dislike recommending specific financial institutions, partly because I used to work for one and I don't want to feel like I'm avoiding them or favoring them. I will say that there are a number of reputable online banks, and I am building out my website. This isn't live yet, but on my website I will be putting some links to articles and lists of good things, and so you can check that out hopefully next week and see some more resources there. You want to make sure above all that an interest-bearing account, a savings account, is guaranteed by the FDIC, the Federal Depository Insurance Corporation, FDIC. They guarantee that you cannot lose any money that you put into a savings account up to $250,000. Now, if you're in the crazy place of having more than $250,000, you might want to split it into two accounts to make sure it's 100% guaranteed covered by the federal government. That's actually kind of important. There was a bank scare about a year ago when Silicon Valley Bank had to be acquired, and there were some bankruptcies, and there was some actual real fear that some of the deposits that those banks held would not be covered, and the federal government stepped in and guaranteed them anyway, but that is not something you can count on. So kind of regardless of where you go, you have to make sure that deposit is guaranteed by the federal government. Again, what you need to look for is FDIC, guaranteed, and that is the single most important thing to do when you're looking for a savings account, especially if it's online and not name a big national bank. So I think that's the most important thing you can do. Let's see if we get one or two more questions. I think it's again a great day. The government kind of forces us to take stock of our financial situation on days like this. Here's another question from somebody. What's the worst mistake you can make in tax season? Is it asking for an extension? Is asking for an extension a mistake? If I decide to save part of that for retirement. Okay, those two things got nothing to do with each other. So the biggest mistake you can make during tax season is not filing your taxes. That's really bad. Don't do it. If you did not file your taxes today, you're still scrambling around for paperwork, you got somebody didn't send you something you need, your cat ate it, whatever, you can do something called filing an extension. You have to do that today, April 15th, and it doesn't get you off the hook for paying what you owe. You have to estimate what you owe and pay that anyway. However, filing an extension gives you some time to pull together all the paperwork and to check and recheck to make sure you haven't made a mistake. And then if the amount that you sent in, if your estimate is a little bit off, that's okay. You can kind of tidy that up later, but you actually have to file your taxes. Now, you don't really have a choice about how much you can save or not save. I guess the only difference is if you make a contribution by today, and as it's now 7:15, it might be too late. Maybe if you're in California, you can still do it. If you make a contribution today to an IRA, you can lower your tax rate. That's not going to be possible in a 401k because payroll processing has already happened, and that ship has sailed. But if you do want to make a contribution for tax year 2023, if you make that by today, you can deduct that amount from your income. But it's we're getting awfully close to the wire here. So I think filing an extension is not going to help you do that. You still have to pay what you owe. I know it's not necessarily a happy thing, but that's the way the system works. So yeah, that's something that's better to do in the calendar year. You've got a little bit of time after the end of the calendar year to kind of tidy those things up, but it gets difficult. Is there a deadline like that for a 401k? Well, 401ks are managed by your employer. 401ks deduct the money from your paycheck, and that has got to come out in the calendar year. So any money that you got in your payroll, your employer automatically deposits, and it's kind of out of your control. I will say, if you're a single employer and have something called a SEP IRA or a SEP 401k, I'm not sure how those rules work. And that is something you should talk to your accountant about. But certainly for a regular 401k where they just take the money out of your account, that happens from your payroll, and that happens by calendar year, and it's too late to make a bigger contribution for last year to reduce your tax bill right now. You can always make that contribution now, but that would be for this current year, 2024. Does the same apply for IRAs? I have one and just set it and forget it. Yep, same thing applies. Typically, you would make the contributions during the calendar year. You have a maximum contribution of $7,000. If you haven't made all of those contributions and you want to rush and get something in again for the prior tax year, the last day you can do that is today. Letting the robot do its thing is good. That stops you from overcomplicating it. And if you can save up to $7,000, having that spread out evenly over the year makes it a little less painful. And if you line it up with when your paychecks hit, you don't even see it in your account, and that's the best way to do it. Let's see if we've got any more questions. If not, I think we want to keep these short and sweet, make them interactive. Do I still need to check the investments though? Okay, so depends. Question is, do I still need to check the investments in my 401k and IRA if the robot does it? If the robot is rebalancing your account, I think it still makes sense to check out what's going on in there maybe once a year on your birthday. It's important to make sure that you selected a risk level in your account that's appropriate for your age. It's one of the reasons I like target date funds. And again, I used to manage those, so I'm biased, but a target date fund or a robo account, an automatic account that will invest and rebalance your account towards the targeted amount of stocks and bonds that you picked is a great thing to have. So if it's doing it automatically, you don't really need to supervise it, but it's a good idea to keep an eye on it again, maybe once a year, just to see how it's doing. Just remember that amount is going to change. It might go up, it might go down, it will go down a little bit sometimes, but it will go up over time. It just won't go up all the time. So just remember, it can be a little bumpy. One of the risks of checking it all the time is that if it is a little bumpy, you can get a little freaked out and maybe sell, and that's almost never a good idea, especially if you're young. I think if there are no other questions, I just want to say thanks so much for joining. Hope this is out there. Thank you so much. I just got a note saying I like your voice better than my bank guy. I appreciate that. Thanks very much. That's one of the nicest things somebody said to me all day. So with that, have a great evening. And check back here in a couple weeks and we'll do another one of these. Save up your questions or shoot them to me on my website, annlester.com, or shoot me a DM or send me something on Instagram. Thanks so much. Have a great evening.